to the module on central banking and monetary policy. With reference to the central banking and the monetary policy, the most important concept that crops up from the theoretical foundation is the discussion on money supply. So when we talk about a money market, it is basically dealing with the demand for money and the supply of money. The demand for money basically arises from the transaction motives, from the speculation motives, and also from the precautionary motives. But with regard to the supply of money, it is the central bank and the monetary policy which plays a pivotal role. So when we refer to the supply of money, it is affected by the group of market participants. Firstly, the central bank or the apex bank of the economy. Secondly, the depository institutions, maybe the commercial banks and other financial intermediaries. And obviously the public. So it is the interaction between the public and the commercial banks which basically refer to the creation of the money, which is regulated and supervised by the central bank as the apex institution. So these are the major participants in the banking structure which also control the money supply. When we refer to the money supply, first of all we refer to the components of the money supply. The components of the money supply refers to currency and deposits. So firstly we emphasize on the concept of currency. The belief that the money has value is self-justifying because currency basically evaluates the money in terms of its valuation, which can be a paper currency or it can be a plastic currency with the advent of the capital markets in terms of the credit cards or the debit cards. So the government convinced the public that the paper money has a value which was considered after the barter economy, because in the barter economy the goods were exchanged and after that the paper money or the paper currency have come up which has a value. Usually the money is a legal tender where the creditors are required to accept the money in settlement of the debts. So this was the very original and historical concept of money in terms of the currency, that money is a legal tender where the creditors are required to accept the money in settlement of the debts, which means that money was considered as the exchange value, which is basically the exchange, and also it is considered as one of the standard for deferred payments. So both as the medium of exchange and the standard of deferred payments, money has been utilized. But actually it is the currency through which the valuation of the money is being done. Next we consider about the concept of currency in a broader margin. Broader margin refers to the role of the central bank, because it is the central bank which regulates the entire money supply and actually looks after the monetary base of an economy. And when we talk about the monetary base of the economy, we refer to the high-powered money, which is basically the currency and the reserves. Because it is the central bank which is responsible for printing the currency as well as maintaining the large monetary base consisting of the reserves, which is the part of the deposits which are not lent out. So it is the deposit which is kept by the central bank, also the gold reserves, the foreign exchange reserves, all these also constitute within the reserves under high-powered money. So the liabilities that the central bank that are usable as money are called the monetary base or the high-powered money. It includes all currency economy, the money supply equals the monetary base. Because it has been seen in the theoretical foundation that whenever we define the money supply, then it is equivalent to the monetary base that is maintained at the central bank. Next we open up for a question regarding the discussion related to money supply, that what is high-powered money. So basically high-powered money is referred as the sum total of currency and reserves, because it is the monetary base of the nation and it is controlled by the central bank. So whenever we talk about the high-powered money, it is the money supply which equals the monetary base and thereby settles the central banking or develops the monetary policy. Now we open up for how the money supply is being channelized by the central bank, basically in the process of credit creation. Because the role of the monetary policy comes up when the money supply is being circulated across the nation with the help of public and the commercial banks. So in order to discuss that, firstly we go for the concept of fractional reserve banking. Fractional reserve banking opens up for the ratio of reserve deposit ratio. That is the percentage of the deposit which will be kept in form of reserves. If the reserve deposit ratio is 1 or unity, entire deposit is in form of reserves and no percentage is lent out. This will be called 100% reserve banking. But here we consider fractional reserve banking. That means if it is less than 1, say it is 2%, then the 2% of the deposits will be kept in terms of reserves and the remaining will be lent out. So all individuals want to keep their money in the bank deposits rather than in currency. This is very important because if the money is kept in idle form, like in the paper money kept in idle cash balances, then it will not yield any return. But if the money or the currency is deposited in any banking institution, it will give a return. So the opportunity cost of holding money is the rate of return or the rate of interest that an individual is foregoing, which is also the rate of return. So that means all individuals want to prefer to keep money in the bank deposits. Liquid assets held by the banks, this is called the liquid asset, which is basically the deposit made in the banking sector, held by the banks to meet the demands for withdrawals by the depositors or to pay checks drawn on the depositor's account, which is called the bank reserves. That means with the help of that deposits, they can make out the checks, they can even withdraw the deposits, and thereby the reserve banking can be done. Next we open up for fractional reserve banking, which has mentioned in 100% reserve banking and fractional reserve banking. So when we talk about 100% reserve banking, then the reserve deposit ratio is unity because entire deposit is in form of reserves. But by fractional reserve banking, it is said a percentage out of the deposit is in form of reserves and the remaining is being lent out. And that is how we can invite all the banks to collaborate together or to coordinate together with the help of the public. And these banks refer to the commercial banks which are monitored by the central bank. So in terms of the fractional reserve banking, we are inviting the reserve deposit ratio, which is the reserve divided by the deposit. So because of the fractional, it is said to be less than 1. So the fractional reserve banking is profitable because the portion of the deposited funds can be used for interest earning loans. This actually follows a kind of a process. The process is like this, that an individual has deposited the fund in bank A. So with the help of that deposits, bank A keeps a certain percentage of the deposits in form of reserves and remaining is lent out. So individual takes a loan from bank A and deposits it in bank B. So bank B also does the same, that is keeping a certain percentage in form of deposits which is lent out and the remaining is being kept in form of reserves. This is the process continued to bank C and thereafter. So once this process gets the momentum and thereby the credit creation takes place on and on, we can say that how the credit creation will take place, and this will refer to the entire system of credit supply. So when we talk about fractional reserve banking, which makes all the banks to come up in an integrated network with the participation of the public through the interaction of the commercial banks, and that is how the credit creation comes in play. So this goes back to the multiple expansion of loans and deposits. This is what we mean by the word credit creation. That is, a multiple expansion takes place, which is a process of increase in the economy's loans and deposits by fractional reserve banking system. It is multiple because more than one bank participate in the process. The economy's loans and the deposits are being circulated and they are being continued on a continuous basis with the reserve banking system. So in this perspective, we invite a question, what is fractional reserve banking? So in the fractional reserve banking, we invite the most important ratio, that is called the reserve deposit ratio, which is said to be less than 1 and which plays an important role in the credit creation process. Next, we move on to the mathematical treatment of the fractional reserve banking. Here we observe that this M, which is considered as the money supply, is basically given by the total bank deposits. So DEP is total bank deposits, which is given by the monetary base divided by the reserves. That means this numerator is the high powered money, divided by the reserves is the bank reserve deposit ratio, and thereby we can say the total bank reserves comes up with this issue. So that is what we say the reserve deposit ratio, which means reserves divided by the deposits. Next we go for how the bank runs. This is because here we want to make the attempt that how all the banks are basically integrated or coordinating with each other. So you have a large number of depositors attempt to withdraw currency simultaneously. The bank will be unable to meet all the depositors, and that will come up to the bankruptcy or the bank run. But this is basically not being encouraged, because here one bank and the other follows a common ratio, and that is what percentage they can do that. So they cannot do that at whatever percentage each bank wishes. That is being centralizedly controlled by the central bank of the economy or the Reserve Bank. This boils down to the most important concept of how we invite the money supply. So we say that the money supply CU is equal to CU, which is the currency, plus the deposits that are being done. And this base is called the high powered money, which is again the currency plus the reserves. So money supply is given by currency plus deposits, DEP for deposits, the first three letters are taken. And this base is the high powered money on the monetary base, which is regulated by the central bank, is given by CU, which is currency, plus RES, which stands for reserves. So in order to find out how the high powered money will be able to generate more credit creation or will be able to accelerate more credit in the economy, we go by the ratio M by base. That is the monetary base or the money supply divided by the monetary base, which is the high powered money, and we just substitute the expressions in the respective numerator, which is currency plus deposits, by the denominator currency plus reserves. So in doing so, we go for money by base, that is the money supply which is considered in the numerator by the monetary base, and we divide by the deposits in the numerator and the denominator, and finally we end up with the ratios. So as we observe in the numerator, this is called currency divided by the deposit, which is the currency deposit ratio, and this is basically the decision of the public, because at what percentage they want to keep the funds as deposits in the commercial banks, and another ratio that comes up is reserve deposit ratio. So these are the two ratios which come up in the creation of the credit creation or money supply, is currency divided by the deposits and reserve deposit divided by the deposits. So these two ratios are instrumental in conducting the money supply. So moreover, we see that in this particular slide, they are being converted into a bracketed portion, and this bracketed portion is called money multiplier. That means if the high powered money or the monetary base increases by 1 unit, then the money supply will be expanding by more than 1 unit due to the presence of this bracketed portion, which is called the money multiplier. So what does it comprise of? CU stands for currency deposit ratio plus 1 divided by currency deposit ratio plus reserve deposit ratio. And that is how we can see that this bracketed portion is none other than the money multiplier. So we can say that the money supply is the multiple of the monetary base. So if the monetary base changes by 2 units, money supply will be the multiple of 2, it will expand. Money multiplier, which is the bracketed portion, decreases if either of the ratios increases, actually comes up. Because if the currency deposit ratio increases, definitely the deposit will come up, and more and less will be in terms of deposit, more will be in terms of currency. So accordingly, less will be in circulation, and so money supply creation will be less. So that actually makes it very clear how the money multiplier depends on these two ratios. So this boils down to the question on What is the expression of money multiplier? So firstly, money supply is the multiple of the monetary base, because how 1 unit of monetary base results to more units of the money supply. And secondly, money multiplier is dependent on the two ratios. That means if any one of the two ratios changes, how the money multiplier will come up, that is an important task. Now we come up with one of the most important functions that the central bank performs under the discretion of monetary policy is the open market operations. Because this open market operations is basically one of the quantitative method of credit control of the money supply. It is where the central bank must change the amount of monetary base or change the money multiplier by sale and purchase of the bonds. And that is the central bank affects the monetary base so that the short-term interest rate also gets affected. So central bank issues bonds, or it actually takes away the bonds depending upon the expansionary or contractionary monetary policy. Secondly, when we consider the open market operations, it also a purchase of asset from the public by the central bank is called an open market purchase. This is basically increasing the monetary base or the high-powered money. This is basically being done by any one of the bonds which are issued by the RBI or by any other financial apex institution, so that open market operations come up and the monetary base gets expanded. On the other hand, the sale of asset also can come up, which is an open market sale. So this is because the public will purchase the asset and thereby the excessive credit will be locked in the hands of public. And this is taken up whenever there is a necessity to reduce the money supply. So open market purchase is basically a result of expansionary monetary policy when there is a need of expanding the monetary base, and open market sale is a result of contractionary monetary policy when there is a need of reducing the money supply. So this goes back to the question on what is open market operations. So we can see that open market purchase is the purchase of asset from the public by the central bank, which is basically one of the most important criteria under an expansionary monetary policy. But in reference to contractionary monetary policy, open market sale takes place. Now we open up with what are the tools of the monetary policy. Because the most importantly, the tools of the monetary policy would be resulting to increasing the money supply, which is basically done through open market operations, regulate and control money supply. By regulation, it is mean that all the components of the money supply like currency, like deposits, even the post office deposits come up, because in Indian economy, the money supply is denoted by M3. The M3 definition, which is considered to be the broad money, that is taken up in the Indian context. So regulation of currency, regulation of the bank deposits, regulation of the post office deposits, all are taken up under these open market operations under the control of money supply. And money supply is also being controlled by different changes in the interest rates or in the policy rates. For example, cash reserve ratio, or the statutory liquidity ratio, or the repo rate or the reverse repo rate. Moreover, the coordination with the interest rates and the inflation is also one of the concern of the monetary policy, because in most of the times it is observed that if the economy experiences high inflation, then the interest rate goes up, because always there is a one-to-one correspondence between inflation and the interest rate. So RBI has to keep a close watch on the direction of the inflation rates and whether the interest rate spikes up due to that. So it is basically the discretion of the central bank to look after the inflation policy management or inflation targeting policy as it is done today. So one of the most important issue that crops up is how to make the monetary policy more accountable and more applicable in practice. Firstly, the practical issues are lagging effects of monetary policy on the economy, because the monetary policy might be adopted 2 years back, but the economy currently may be under certain shocks. So how the policy rates can be adjusted to keep up the expectations of the investors, expectations of the businessmen, and expectations of the corporates and the general public. Because in most of the times the credibility of the monetary policy is questioned if the policy rates are changed on a frequent basis, particularly changes in the repo rate or the reverse repo rate. So keeping in view the expectations of different stakeholders of an economy, it is necessary to look after the credibility of the policy. Secondly, the uncertainty about the channels through which the monetary policy works. Because monetary policy works through stock market, works through interest rate fluctuations, the volatility in the different assets that are there in the global market, and also through the global fluctuations. So if there is a slowdown in the global economy, then the monetary policy will be reactive to it, and so the uncertainty may cause monetary policy to lose its credibility. So it is very important that the economy gains resilience over the years, that is the capacity to absorb the shocks, making the monetary policy to be more certain and credible and convincing for the general public. This boils down to the important concept of credit channel. That means where the commercial banks are to be given more autonomy, the commercial banks functioning to be monitored, and they should be more transparent and accountable in their operations. So the reduced bank reserves lead to smaller quantity of customer deposits and reduced lending by the banks. This is very important because the customer deposits should be taken up in a serious note, because most of the time some of the debts or some of the loans end up in the bad loans, which can erode the efficiency of the banking structure. High interest rate always discourages investors because it increases the cost of borrowing, lowers the profitability. So in most of the cases, the credit channel should be transparent and accountable in this regard. So we can come up with a question on what are the tools of monetary policy. So as it is seen that the most important tool of monetary policy is to increase the money supply, open market operations to be done, to regulate and control the money supply, one of the essential and the traditional and a conservative function of the central bank, to coordinate with the interest rate, particularly in terms of price stability, particularly in terms of inflation targeting policy and credit management. So in this particular module, we basically discuss on the concept of the money supply, that is the component of the money supply which is currency and deposits. This currency belongs to the paper currency, even today the plastic money, along with the deposits which is bank deposits, post office deposits and other deposits made in the financial institutions. Thereby comes up the role of high-powered money, which is controlled by the central bank as the monetary base. High-powered money comprises of currency plus reserves, so that we can invite the concept of money multiplier. That is how one unit of high-powered money can have a multiple effect on the creation of money supply. This basically goes down to the role of monetary policy, which is there in the open market operations and also changes in the policy rates. The tools of the monetary policy refers to mainly the quantitative and the qualitative credit control measures, but most importantly, the credibility of the monetary policy is important, taking care of the expectations and also the future inflation rates. The credit channel also comes in place where the commercial banks, the public, work on a symbiotic basis to ensure the better, proper and efficient functioning of the banking system. Thank you.